Hello and welcome to this video. Today we will look at the economic implications of China's regulatory crackdown on tech companies. We will also look at the opinion of Cathie regarding the Chinese market crash and the adverse effects of regulatory crackdown. We will also cover other major events unfolding in China, their impact on Chinese economy and economies across the globe. Also, what are the motives of Chinese government behind this crackdown? So here is what Cathie has to say about the recent actions of the Chinese government.
On China and what we're seeing in terms of this regulatory crackdown, which seems to be worse every single day.
Yeah. I think there's something going on there socially that the government is very worried about. Many of the same things that the rest of the world is worried about, whether it's the divide between the rich and the poor. I saw today Evergrande. There are protests around the Evergrande offices because the wealth management products that weren't highly regulated are not paying interest or not paying back and so forth. So I think there's social unrest taking place there. And that's why common prosperity has become the rallying cry, and hostage to capital has also become a rallying cry. So I don't think it's a very friendly place for capital now. However, focused only on innovation, China has, in its various 5-year plans, made innovation an incredibly important plank.
Right.
And so we don't want to avoid it, but what we do want to avoid is very high margin companies. So you look at JD Logistics or JD.com, some of the companies that are pushing innovation and access into tier 2 and tier 3 cities will play with that. So what we did in the series of moves recently around China, we have taken our position down significantly, but stayed with a few of
what would it take
the low
for
margin
returns
to
invest more? What would you need to see?
What would I need to see? I think it would be Xi Jinping saying, whoops, we made a mistake, we're open for business. I don't think he'll do that. So I don't think we'll be hugely involved with China.
So one thing worth mentioning over here is that China's income inequality is amongst the world's worst. The gap between the rich and poor in China is almost as huge as in the USA. Despite the global recession triggered by the COVID-19 pandemic, China has managed to largely avoid economic fallout. It reported a rise in GDP of 7.9% for the second quarter of 2021 compared to the same period the year before. And with annual growth rates averaging 10% over the past 30 years, China has become the world's fastest growing major economy and the second largest economy overall behind the US. But while this rapid expansion has lifted millions out of poverty, it has also widened the gap between the country's richest and the poorest. As we can see in this chart, China has more income inequality than almost all Western countries. So I agree with what Cathie mentioned. In my opinion, the regulatory crackdown on tech companies as well as the real estate sector reveals the strong intent and commitment of Chinese government to support its middle class. Therefore, China wants to avoid the enormous inequality like the USA, where it has already led to the deterioration of social stability. The elements of resentment towards the ultra-rich billionaires is harmful in the society, and it is growing in the China just like the USA. Therefore, the government wants to put an end to the already high income inequality and wants to shatter the low income mobility between generations. Under the surface, a bubble of epic proportions is forming, as can be seen by the explosive growth and euphoria across the real estate sector, the stock market, and even the non-correlated asset classes like cryptocurrencies. And when things are way out of the affordability bracket of most of the people, there has to be a correction at some point, and I believe that an epic market crash is approaching. And this is exactly what Cathie explained in this interview.
We're looking at China today, much like we were looking at Japan in 1989. So in 1989, Japan was at the peak of its real estate boom. The Nikkei had hit 40,000 or was close to it. And the world largely thought, wow, there's no stopping Japan. Japan's going to become the largest economy in the world. And of course, that didn't happen. Japan's boom, real estate boom, was destined to unravel. I'm sure many of you have heard the story where the emperor's palace in Tokyo, that piece of land, was worth more than the real estate in the entire state of California, which also had seen nice real estate inflation. So that was destined to fail. And the Nikkei has yet to get back to that 40,000 level. So that's 30 years later, 2 years later.
And let's see how the things have played out in Japan in the last 30 years after the bubble burst. What follows was a spectacular fall from the highs of the mid to late 1980s. The stock market plummeted, losing more than $2 trillion in value by December 1990. In the years that followed, the Japanese surveyed an alien landscape of restructuring, code for cost-cutting, deflation, and stagnation. When the bubble party ended, its hosts appeared to have no idea how to clean up the mess left by absurdly high share and property prices. So Japan's 1980s bubble was the bursting start of a long adaptation from a young, fast-growing economy to an aging, slow-growth new normal. And the Nikkei index reached its all-time peak on 29th of December 1989. And as we can see, even 30 years after that, we are still well below that level. It took until 2002 to bail out the banks from the real estate adjustment. It took another 10 years to put the necessary supply side and social security reforms in place. The benign impact of the global financial crisis has shown that Japan's economy has fully adjusted to its new normal of slow but solid long-term growth. And now let's see what Cathie Wood said about the importance of real estate sector in China and also the consequences of government crackdown on real estate.
China's real estate has been very, very important in terms of propelling its economy forward. It was part of the infrastructure build out. They needed it, but it also became the most important part of consumer savings. By some estimates, 75% of all consumer savings in China is in real estate. Now, China's cracking down on real estate and home prices are falling. And there's a bit of social unrest about it, but China's trying to tackle the have and have not problem, the social unrest. Certain people have these magnificent homes or are in magnificent buildings, and others can hardly afford a tent. This has become unacceptable and untenable in China, according to its leaders. And so it's driving these prices down, and those who have the savings in the first place are losing the money, but this is a risk China's willing to take. I think China's playing with fire on this particular topic, especially because they are also targeting the financial regulators who oversaw financial institutions who were lending to the real estate sector. And the national government is also investigating certain financial firms. So, this is the lifeblood of their economy.
So the main issue which I would like to highlight over here is that the local governments are not able to generate the enormous revenues from the sales of land plots anymore, since the builders are not taking risks during these turbulent times of uncertainty. And the local governments in China have huge debts too due to years of bad investing decisions. And with that revenue source gone, they are indeed going to face financial pressure. Furthermore, the Chinese builders are defaulting one by one, and this has caused severe panic in the market. 9 Chinese developers have not defaulted on US dollar bonds in 2021, according to data compiled by Industrial Securities. These developers include Oceanwide Holdings, Fantasia Holdings Group, China Fortune Land Development, Sunshine 100 China Holdings, Tianfeng Group, Tahoe Group, Cynic Holdings, and Sichuan Language Development. They owed a collective $28.1 billion US. So let's see how long Evergrande can stay afloat. People are pulling money out of the real estate sector, and this massive fear has caused the prices to go downhill, and a bubble burst of humongous magnitude is about to unravel. As Cathie Woods already drew a parallel between the Japan's 1989 market crash and that of China, I believe that we are going to see an unfortunate end to this euphoria. And this is not all. In fact, Jack Ma's treatment prompted Cathie Wood to quit China. So Cathie Woods has been ripping investments out of China, citing concerns about the treatment of corporate leaders. She said, "We have gone into China because we saw their reaction to COVID. It was the most disciplined country in terms of monetary and fiscal policy during the crisis, and I thought China has the possibility of becoming the Germany and Switzerland of the world. But as soon as Jack Ma was banished, effectively last November, we started pulling back. During February through May, we were down 37%, so we concentrated our conviction." And in my opinion, the effects of Chinese government sanctions are devastating, since the Chinese regulatory crackdown on tech companies has plummeted their stock prices and wiped out billions of US dollars from their valuations. And this is the impact of fear and uncertainty due to Chinese regulatory crackdown on the price of Alibaba stock. And let's zoom into the chart of Alibaba over the past 12 months, and we can see that it is a flood of red. We can see that nearly half of its market cap has evaporated in the air of regulatory uncertainty. And many experts have predicted that the Chinese crackdown can last for decades. Despite that, on the other hand, many long-term investors see this as a good opportunity to accumulate Chinese tech stocks, and they see it as a good value investment currently. In the end, I would like to mention that I am not investing in any Chinese stocks currently, since no one knows the long-term consequences of government crackdown on the stock prices of Chinese tech companies. And investing right now will be equivalent to burning my capital to ashes, which I will not do. I hope that you liked the video. Please press the like button for the YouTube algorithm, and also leave a comment because the YouTube algorithm likes it. If you would like to watch such content, please subscribe to my channel because I release such videos each week. I will be grateful for your support. Thank you very much for your time and have a nice day.